My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I'll be one of my friends. I'm just trying to make a little money. My job, not just entertainment, to educate and teach. Call me, 1-800-743-CNBC, or tweet me at Jim Cramer. All right, I've been thinking like this. Maybe every stock just got too expensive. Maybe everything was simply too high and had to come down to more reasonable levels. Well, that's certainly how it feels after still one more bad day, where the Dow lost 229 points, S&P dropped 1.15%, and the Nasdaq plunged 1.87%. Getting used to that yet? We're seeing all sorts of stocks lose gobs of points. And it's often happening for no apparent reason. Sure, we've had shortfalls this earnings season and tons of de facto guidance cuts, where you beat the numbers for the quarter but don't raise your full-year forecast. However, the treacherous thing about this market is that if you see even one stock coming down hard in a particular sector, you know the rest of them are going to implode too, perhaps coming down even harder than the original culprit. Of course, many of the problems relate to individual companies. Both Microsoft and Alphabet are classic examples. They reported after the close. Both reported what looked to be very good numbers, but not good enough numbers, but maybe good enough because of a weak dollar, or maybe not. If they had a weak dollar, maybe they'd be better. Strong dollar now? Yes. It is that confusing. You can't even get a read when the stock's right in your face, and that does cause you to pull back itself. For 45 minutes, I looked at these. No one knows if they're good. I swear to God, the companies don't even know. But sometimes it is real clear, and everybody knows. Like with the stock of America's largest retailer, Walmart. It pre-announced a huge disappointment last night. I mean, one of the worst I have ever seen. And weighed heavily on the tape all day, bringing down the entire retail cohort, if not a huge part of the market. That's easy because they're all in the same ETFs. We had layoffs at Shopify because they misjudged e-commerce's growth, just like Amazon crushing anything that even looks like an e-commerce stock. But for the most part, the earnings today were actually solid. That's what's really confusing. McDonald's reported such a great number. Oh, much better than expected. I was pleasantly surprised at how General Electric's doing in aerospace. Also healthcare, even power. I loved how 3M announced a giant spin off its healthcare, taking its healthcare division out. Very clever plan to cordon off some liabilities stemming from allegedly faulty earplugs for service members. NXP Semi, the chip maker with heavy auto exposure, delivered a strong beat and raise. Yes! Still, all of this good news just wasn't enough to lift the averages because there were just too many negatives and stocks may just be too darn high. The analysts played a role in today's fiasco. A brutal downgrade of the once invincible cybersecurity company Zscaler crushed that whole cohort, which had been one of the strongest even during the downturn. It hurt competitors like CrowdStrike and Cramer fave Palo Alto Networks. But what I think did this market in was the same thing it's done it in for almost the entire year. Persistent inflation, coupled with a Federal Reserve that can't seem to win no matter what it does, not to mention instability in Europe thanks to Russia's invasion of Ukraine, the weakness of China caused by the lockdowns, and the immensely strong dollar. No matter what we do, we can't escape the tentacles of these issues. And by the way, that includes the confusing Microsoft and Alphabet quarters tonight. I found myself thinking with Alphabet, well, hey, you know what? At least it isn't Snap. Low bar. Perhaps we can get some bad news as good news relief tomorrow when the Federal Reserve will raise interest rates again. Still, while we've had some relief rallies over the years when the Fed tightens and then tends to, let's say, we're done for a while, but I don't know if they're going to do that yet. We're not that far along in the rate cycle. Yeah, I'm sure the Fed is betwixt and between themselves about how much, what to do given so much is going on. So I'm going to put you in the dilemma. Let's go through the dilemma of what Jay Powell must be thinking, because it really makes sense why even he would be confused. I want you to think of last Friday. On Friday, American Express, which everybody knows, great credit card company, right, reported about the best quarter I can remember. There's tremendous spending going on, travel, going out, restaurants. It's so far above 2019, it's insane. There seems to be no stopping people from going all over the place. especially young people who are using credit cards in incredible numbers. But then today, Walmart stock got crushed because the consumer apparently doesn't have much money to buy groceries and then buy clothes. Now that there's no more stimulus, Walmart seems astonished by the lack of spending. They think the consumer's tapped out because of inflation. So on the one hand, you have a consumer who's crippled by the endless rise in food prices and the formerly rising price of gasoline, so crippled that all these dresses, pants, and sneakers languish on the shelves. On the other hand, the consumer will pay anything to go out and have the time of their life in any country, especially because the dollar's so strong. It's easy for Jay Powell to say that American Express and Walmart are talking about two different consumers, regular people who tapped out because of inflation and the wealthy who are spending their darn fool heads off. He wants to slight the wealthy, right, not the working person? But there's got to be some overlap, so that makes no sense. If you're Jay Powell, you want the economy to slow down to the point where there are enough people to fill jobs at Raytheon Tech, 5,000 engineers needed after a good quarter, without raising wages too aggressively, but without a ton of excess unemployment either. What a needle to thread. Who could be that good? And plus, we know that 45 million people switched jobs in the last year, mostly for better pay. But then again, who cares if the better pay is only up 4% when the entire cost of living is up 9%? Think about these things. Think if you had his job. So what does Powell do here? Does he say that the glut of goods at Walmart should lower the price of clothes, meaning he's winning the war against inflation? He might not need to tighten as aggressively going forward? Or does he say food and gasoline are too high, so he's going to slam the brakes on the economy, create more gluts that will push prices lower and hope that food comes down with that? Nobody knows. And when nobody knows, the Wall Street playbook says, sell, 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 especially ahead of a Fed meeting. Sell, sell, sell. Now, here's where it really gets difficult. It isn't difficult already. We're in the toughest earnings week of the year. We know it only takes one misstep at a single company to bring down every other stock in the sector. Everything is guilty until proven innocent. Plus, the whole market feels too high if the Fed's going to have to keep hitting us with these series of these big rate hikes to catch up with inflation. That means we simply don't know what anything's worth. We have too many things going wrong to be able to make a judgment, which gets us back to Ukraine and China. If we had an end to the war, then we'd know that things would get better in Europe. Russia just needs to declare victory and move on. That'd be extremely rational. But each day, a rational outcome there seems less likely. As for China, we keep thinking the Communist Party will come to its senses and start using the good mRNA vaccines. But it seems to have no interest in using anything that isn't homegrown. So let's put it all together. You have an uncertain Fed, an uncertain Europe, an uncertain China, an uncertain America, with rates going up, not down. All told, these things tell me that the stock market in its entirety is still too high. So we have to let the averages come in before putting more money to work. But it might be worth doing so because there's so many good things that can ultimately happen. Can individual companies save the day? Well, Alphabet, the parent of Google, just reported a worse than expected but better than feared quarter after the close. The stock still rallied in after-hours trading because it had already come down so dramatically from its highs. The lesson, at least for Alphabet, the bar had been lowered to the point where this was good enough. Not a great reason to buy, but perhaps a reason not to sell. Microsoft isn't holding up as well. Their cloud business is weaker than expected, and their gaming business is getting slammed. Then again, the fact that it wasn't down more tells you that this was already priced in, too. Again, the dollar's playing havoc with both companies, so it's hard to figure out how they're really doing. And we do have some genuine upside surprises. Look at Chipotle roaring in the wake of a fantastic quarter, thanks in large part to their ability to raise prices because their food's so good. Then again, that's not what you want to see if you're hoping the Fed can win its war on inflation without cratering the whole economy. But the bottom line in this exhausting tape, it's a tough moment because the situation is so darn confused by the dollar, by the Russia-Ukraine war, by the Chinese lockdown, rising short rates, retreating long rates, a sure sign of recession. And we won't have any real insight where this market's headed until tomorrow afternoon, when maybe we'll get some clarity from the Fed. It's just a tough moment for everyone, from the Fed to the trading desk to you. And it doesn't seem like to be the time to be, let's say, heroic. Lane in New York, Lane.
Jimmy baby, big Boston Red Sox, booyah to you, big Jimmy daddy.
I don't think it can get better than that, except for maybe big has got to do with, the wrong part of your, well, no, I don't want to get too deep in that. Go ahead, Lane, what's up?
All right, what would be better for my portfolio? Me keeping Home Depot or going with a company like Tractor Supply? I work for both companies. Both have a good yield. What do you think I should do, Big Daddy Cramer?
Oh, boy. Well, you know, I pulled up with Hal Lawton last week, and I don't know if you caught that interview from what he's doing at Tractor Supply, but I think that they're terrific. It really is. And there, at least we know how they're doing. We don't have to sweat the program like we have to do with Home Depot right now, Lane. Tractor Supply would be the one for me, simply because I don't know how Home Depot is really doing. Right? This is a confusing moment, everybody. And we won't have any real insight into where this market's headed until tomorrow. Maybe we'll get some clarity then. No heroics, please. On Mad Money tonight, I'm getting the real deal in steel with the top brass of steel maker Nucor. Then Logitech reported a disappointing quarter. But just like the rest of this tape, the stock managed to rally. I'm digging deeper into the quarter and what drove the action with the company's CEO. Plus, is the strong dollar actually hurting companies this earnings season? I'm taking a closer look at foreign exchange headwinds like those we have never seen and how they might be impacting bottom lines. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.